Now, with the market's upward momentum momentarily derailed by a cut to the U.S. credit rating, what should investors be looking to build or sustain with regard to wealth? So joining me now is Anthony Saccaro, president of Providence Financial Insurance Services. Thank you for joining us here. Let's answer the topical question here with respect to retirement, please.
Well, I think that there's one thing that we have to be careful of, and that is we're not out of the woods yet. Some of the conversations I've had with clients, is they feel like maybe we're not going to have a recession. So I want to caution everyone first that a recession could still be around the corner. We do have an inverted yield curve. But how to build wealth with investments is what I'm recommending to my clients is to focus on income producing investments. You know, when you look at the market history, the fact is there are long periods of time where the market has no growth, followed by long periods of time where the market does really well. And we've just come out of a 13-year period starting in 2009 where the market's done really, really well. And a lot of analysts, a lot of professionals, including myself, are thinking that the next decade may not be so good. So you have to invest for what you know you can count on. And that would be income. Dividends and interest. If you have an income portfolio and it's diversified with high quality companies, you can count on your income. If you're a senior living on your income, you want to be living on the interest and dividends so you're not cannibalizing your principal. And if you are in the accumulation phase of life, growing your portfolio, then the dividends allows you to get paid while you wait. So you can grow your portfolio through dollar cost averaging the dividends back in. It's a good strategy for saving for retirement. And it's also a good strategy to reinvest dividends and interest back into your portfolio, dollar cost averaging. Great strategy.
Let me ask you, does it depend on demographics here? Does it depend on your age, how many years, decades you have until your retirement? Is this a strategy for everybody?
No, it's definitely, well, let me back up. It does depend on your age. Yes, 100%. If you have 10 or more years to retirement, you can be more aggressive. You can have a higher equity portfolio. I would think that waiting for a pullback would be a good time. I wouldn't get in everything right now, but dollar cost average in. If you have 10 years or less to retirement, you need to start pulling back. A big mistake retirees make is they wait until the day before they retire to make a change. And for the last decade and a half, they've gotten away with it. But for the next decade and a half, maybe not. And if you are retired, you got to really focus on income. At least cover your income needs through dividends and interest, and then you can invest the rest a little more aggressively if you want to.
Makes sense. Any assumptions here based on an interest rate that stays higher for longer? And where I'm going with that is markets are expecting the Federal Reserve to hold interest rates at these higher levels. But for instance, if we did get a market crash and we did end up cutting by 400 basis points, as is pretty customary during recessions, what then?
Yeah, that's a big question that I'm having to address with consumers. And it's likely that that's going to happen. It's likely there is going to be a correction. There could be a crash. And I want my clients to plan for the worst case scenario. And a mistake that I think a lot of consumers are making is they're jumping on the short-term bandwagon with long-term money. They might be investing in a one-year CD at 4 or 5% or a two-year CD at 4 or 5%, not realizing that what they're doing is they're going to enjoy that interest rate for 1 or 2 years. If the market crashes, we have a 400 bips drop on the Feds and their CD matures in a year, they might only be able to get 1 or 2% on that CD. So it's a great time to invest for fixed income because not only are fixed income investments depressed at this point, the most depressed they've been in over 40 years, you can use fixed income as a capital appreciation play and lock in higher yields, not just for 1 or 2 years, but also for 5 or 10 years. So putting longer term money in shorter term CDs is a big mistake. But I see that happening. I'd caution consumers not to do that.
Yeah, well, I was just remarking earlier, I don't know if you want to go 30 years out on the curve, but that is now paying higher than the 5-year again. That's probably fodder for a different conversation, but I want to talk about 60-40. Last year was the worst year for 60-40 in decades. What should investors be thinking about in terms of market mix portfolio balance? Is it safe to go back to 60-40, or is that kind of a dead paradigm given the new interest rate structure?
Yeah, great question. 60-40 has been talked about a lot. I think the answer to that question really goes back to what we spoke about a few minutes ago, and that is, what stage of life are you in? The whole point of a 60-40 portfolio is if the 60% drops, the 40% goes up. If the 40% drops, the 60% goes up. You've got this inverse correlation with bonds and stocks that is supposed to be the way it works. But for the last few years, it hasn't worked that way. So 60-40 portfolio with interest rates going up and the stock market going up, has not really worked the way that investors have hoped. So it does depend on the phase of life that you're in. The 40% provides more income. If you're a little bit older, I think flipping that around, maybe even going a 40-60 portfolio, 30-70 portfolio, if you're living on your income and you got to be more conservative. But if you're in that accumulation phase of life, you can even go more aggressive than that 60-40.
Want to talk about geopolitical uncertainties. We've had at least a war over in Ukraine with Russia. We've had China reopening delayed. We also have growing antagonism with respect to the tech culture between the U.S. and China. How should investors be thinking about this and navigating a less safe world that it seems that we've emerged in?
Yeah, it's a great question. And I think part of that conversation comes back to AI, too. We're getting a lot of questions about this AI craze. And a lot of investors want to know, well, how do I get in on that? What's the one company? What's the Apple that I can buy that, in 10 years is going to be, take my $10,000 and make it, millions of dollars like that would have been if you'd have bought Apple 30, 40 years ago. And I'm going to just caution you, don't chase a company. You want to consider AI and what companies are doing with AI. But you got to be really careful. When it comes to the geopolitical uncertainties, that's another thing that you have to keep in mind as well. But you can't avoid them. You can't avoid the tensions we have with China. I had a client come to me recently and said, I don't want anything China. Well, good luck. You're not going to be able to invest in anything that's not going to be relevant to China. So it's something in the background. It's one of the pieces of the puzzle that you've got to consider, along with interest rates, along with potential recession, along with investing for income. So it's definitely a big piece of the puzzle.
Yeah, it seems the deglobalization trend is kind of beginning, but we are still completely connected and interdependent here. Really appreciate your insights. Thank you, Anthony Saccaro, President of Providence Financial Insurance Services.